Financial crises often expose the hazard of opaque capital. When panic sets in, the actual reserves of an institution can appear as an impenetrable black box, leaving the public with no means of verification. The Basel III framework addresses this by pairing higher capital requirements with a system of verified disclosures. Pillar 3 provides the enforcement mechanism for this framework. Developed by the Bank for International Settlements, it codifies market discipline as a mandatory regulatory standard. Under this mandate, financial institutions must adopt standardized cross-jurisdictional transparency, reporting their risk profiles and capital positions using identical mathematical syntax. In India, the Reserve Bank of India is responsible for applying these global standards across all scheduled commercial banks. The RBI initiated this shift with the new Capital Adequacy Framework guidelines in July 2012, setting the stage for a phased rollout of Basel III starting on April 1, 2013. This rollout operates on a precise schedule. Banks must fully transition their capital accounting to the new standards by March 31, 2017. To monitor compliance, the RBI relies on a specific reporting instrument outlined under Section 14.11 of the Master Circular, Table DF11. Analyzing the architecture of Table DF11 reveals the three-step reconciliation pipeline required to prove compliance. By forcing all institutions into a single mathematical framework, standardized templates ensure that institutional risk profiles are comparable at a glance across different jurisdictions. The post-March 31, 2017 disclosure template serves as the definitive baseline for Basel III compliance. Its layout is structured to list all regulatory adjustments, preventing underlying data from being obscured within broader categories. This table follows a strict visual syntax. A dark gray row signals a new category of regulatory capital. Beneath these, light gray rows without thick borders act as sum cells. Finally, light gray rows with thick borders identify the main components and final capital ratios. The top tier of the table contains the Common Equity Tier 1, or CET1, section. This starts with the bank's directly issued qualifying common share capital and its related stock surplus. Subsequent entries record the bank's retained earnings and accumulated other comprehensive income. This formatting logic converts internal accounting into a machine-readable structure that regulators can parse quickly. Before reaching the finalized 2017 standard, banks must navigate the transition period that began in 2013. Institutions face a mechanical challenge. They must phase out Basel II adjustments while simultaneously phasing in the new Basel III rules. To manage this overlap, the RBI requires the use of the Part 2 transitional template. The Master Circular identifies these transitional columns with a specific visual marker, dotted borders. These columns isolate the specific amounts of capital that remain subject to pre-Basel III treatment. We can see this dual reporting logic at work in the treatment of available for sale, or AFS, debt securities. When market volatility impacts the value of these securities, the bank must reflect that impact on its balance sheet. In this scenario, let's assume a bank is reporting an unrealized loss of $50 million on its AFS holdings. Previous national rules in some jurisdictions allowed banks to filter out these unrealized losses entirely from their regulatory capital. Within the Part 2 template, this $50 million loss is partitioned into two distinct data streams. One portion is recorded as a Basel III phase-in adjustment, while the remainder is placed in the dotted border column under the existing legacy treatment. This dual reporting allows the market to see the precise impact of regulatory change as it occurs. Table DF11 only provides value if its figures can be verified against the bank's public financial statements. To create a verifiable audit trail, the RBI mandates a three-step reconciliation process. Step 1 begins by taking the baseline figures directly from the bank's published financial statements. These figures are then placed in a parallel column, adjusted to reflect the regulatory scope of consolidation. Step 2 involves the decomposition of specific regulatory line items. Banks must break down certain asset groups if the individual components are subject to different regulatory weightings. The RBI highlights the item goodwill net of related tax liability as a primary candidate for this step. To comply, this item must be split into a distinct goodwill node and its related tax liability node. Step 3 completes the process through direct mapping. These decomposed elements are then tethered directly to their corresponding reference rows within Table DF11. This three-step engine tethers complex regulatory capital ratios back to the basic public accounting used in financial statements. This creates a continuous data pipeline, tracing a data point from the accounting balance sheet through decomposition and the transitional template to the final capital ratio. Accurate calculation, however, is only one component of the Pillar 3 mandate. Under Section 14.1, the RBI sets strict rules for the accessibility of these disclosures. Banks are required to provide a direct, prominent link to their regulatory disclosures on their main homepage. They must also maintain a publicly available archive of all templates from previous reporting periods. This archive must be preserved for at least 3 years to allow for historical analysis by market participants. If these disclosures are difficult to locate or access, the effectiveness of market discipline is diminished. When complex financial proofs are structurally uniform and accessible, they provide a consistent baseline for the global market to assess institutional risk.